Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's the end of the year tax planning for 2013. And on today's show, 5 things you can do this year and next year in tax planning. And with me today is certified financial planner and CPA Ken Davis. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to day 5, Ken. Wow, now we get to actually talk about things, right? Because we want to make sure, if you've missed the shows previous to this, you really should watch it in succession. We think it's a good building block, a good tutorial, and a great learning experience.
Well, and I think that's important because in order for us to have communication and to do planning, we have to understand the basic concepts, what I call the building blocks, before we can make the building. We have to understand what the different pieces are.
Well, I love the kind of David Letterman top 5, this, that, and the other. And you have some interesting ones here, especially if you're a business person. You talk about 179, and I have to tell you, sometimes I forget about how big that is. Talk about section 179. I can actually purchase equipment and other office issues, equipment, computers, everything else, Mondo pads, and the ones under 179, even if I buy it before, as long as I buy before the end of the year, I get the full year?
Well, yes, that's correct. Normally the concept of depreciation is that it has a useful life. You buy an asset and you depreciate it over a period of time, and that's the government's attempt to match the cost of using equipment to the income that's earned. That's basic accounting principle. However, Section 179 is intended as a business jobs creation stimulus type of package. It allows small businesses to, and fairly large businesses actually, to buy equipment as long as the equipment is put into place before the end of the year, and it has to be functional and used before the end of the year. In other words, on December 31st, you could go down to Best Buy, buy your computer, put it on your desk, hook it up, and actually tie into the internet and look at your email. You've used it, okay? It's now in place. You did it the very last day of the year, and you get to deduct the entire cost of the computer. You don't have to depreciate it. And there's limits on it. I think it's like $500,000 this year. Next year, without a change in the tax law, it drops all the way back down to $25,000. So this is the year to get your goodies and
179 is going to drop that steeply.
Well, if they don't change the tax law, I was just reading online yesterday. Maybe this stuff changes all the time. Maybe it's already happened. I don't know. But the fact is, right now you can get and make sure you work with your tax advisor, especially on this types of stuff. There's different classifications of property. And what qualifies. There's certain companies or certain phase outs if you get to certain sizes. So it's not as simple as it sounds, but generally in many cases small businesses can deduct the entire cost of the asset. Maybe you're sending out direct mail campaigns, and you've been folding the letters or hiring people to do that. Now you buy a folding machine that folds your letters and does in minutes what used to take hours. And maybe you have a sealing machine for your direct mail or whatever. If it's business related and it's used for business, then you can get this full deduction for the entire value of the asset.
Well, and some people are thinking about, hey, I'm going to start funding my IRA. Now, some people try to defer this till April 15th, but some people like to get it up and out of the way because they don't want to procrastinate. They want their money in the market or in their savings vehicles.
It's a time value of money concept. The sooner you get the money in there tax deferred, the better off you are. If it's just sitting in a checking account until April 15th, what good is that? It's not earning any money, and if it does earn money at, say, some paltry 1%, you pay tax on it. Well, go ahead and put it into your IRA now or your qualified plan and get the asset growing at a much higher potential rate and get tax deferral. That extra time makes a big difference in terms of how much you've got, even just a 1-year difference.
Talk a little bit about tax harvesting, capital gains and losses, and matching those up.
This is a pretty sophisticated type of thing. You have to be careful because the way the tax law is, it looks at short-term capital gain, short-term capital losses, long-term capital gain, long-term capital losses, and it has a whole formula and process to determine what comes out the end of that chute in terms of how it pairs it up and matches it. But generally the idea is maybe you've got some assets that have made a very nice profit that you want to redeploy. You want to sell them and buy something else, but you're going to pay taxes on it, even though it may only be 15 or 20%. But then you have some positions that are in loss positions that you really don't think are going to go anywhere. So you go in and you look at what your loss positions are and what your gain positions are, and you can manipulate the whole thing to create losses that match the gains. Now you want to make sure you're matching up properly, and again, having a competent tax advisor probably makes a whole lot of sense here, unless you're astute and you've done a lot of study and you've read, online we have all this information. If you really want to get to know it, you may be able to do it yourself, but an advisor would already know how to do that, can advise you what to sell and what to purchase.
Yeah, without question, our advisors that are into this big time understand it. And if they're not, you need to go to school on this, because I think this is really a critical and complicated matter. Ken, I want to talk to you real quick. We need to accept, if you're in a foreclosure or a short sale, this is the last year of the forgiveness indebtedness. Did I get that right?
It has not been extended as far as I know.
Yeah. It could be, but right now.
I got online, didn't find anything that said it had. I haven't heard anything in the news. But basically, if you have a house that you've been hanging on to and you're going to need to walk away, you've had a divorce, you've hit hard times, whatever, the government put in special relief for people in those difficult times. Normally, when you have debt relieved or forgiven, that's considered like you got cash. You got $100,000, $500,000 loan, or $400,000 house, and you turn the house over to the bank. And they sell it for $400,000. There's $100,000 of forgiveness on that loan that normally would be taxable under certain circumstances. And again, they don't make it easy. If you borrowed money to buy boats and stuff like that, you may still have to pay tax. If you bought it to refinance and put it back into your property, there is the forgiveness. Do it this year.
Do it this year. And by the way, when you're talking about doing things this year, charitable giving all the way up to the end of the year, you still have time to write a check. When we come back from the break, we're going to talk about the things you can do for next year to prepare for end of the year tax planning 2014. Oh my gosh, we're trying to get ahead of the curve for once. And don't forget, you can request all our show documents as we use sample examples from Backroom Technician at ashbrokerage.com, or you can sign up for your own 30-day free trial offer from Backroom Technician. Just go out to brt.com/trialsignup.aspx. We'll be right back with more from Ken Davis on the 5 things you can do for 2014, right after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Welcome back. I'm Steve Savant with Ken Davis. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right at ashbrokerage.com. Just click on the show logo and it'll take you right out to the homepage. Just a heads up, before moving forward with any of the ideas on the show, always consult your tax advisor, your legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about 5 things you can do in the future. But before we do that, just wanted to touch a little bit at the end of the segment, Ken, because we don't know if these laws are going to change. This all could change.
Yeah, I was pretty emphatic. Go ahead and do it. But the fact of the matter is there may be other issues that your advisors would say, well, yeah, that's a good idea to get that, but these other issues crop up, or, gee, we think the law is going to be extended and you'll have more time. So, check with your advisors.
We are always, Ken and I are a big proponent about paying early into your qualified plans. The sooner you start, the better, you're going to have the market, you're going to have, hopefully the market, who knows. But just you're trying to not procrastinate. And so one of the number one things that I saw on your list right at the top is, did you pay yourself first?
Well, that's exactly right. In fact, there's a very nice piece in Backroom Technician, which is part of this package they can get from us for free, is it shows an example of what if you funded at the beginning of the year versus the end of the year and how much more money you'll have at the end. It's not massive, but it's very substantial, and it's worth doing it early. So do it early and don't wait till the end, because this gives you a deduction and a deferral. There's not many opportunities in the tax law these days to get both.
I like that idea. People say, but I don't get any deduction at the end of the year to buy cash value life insurance, so why is this on a CPA's list, Ken?
Well, if you do life insurance for wealth accumulation like you and I do, where we maximize the cash value, minimize the insurance, and avoid the modified endowment contract rules, it becomes a product that looks very similar to a Roth IRA. Yes, it has a cost of insurance that a Roth doesn't have, and so you have to factor that into your calculations. But there's other things like you have access to your money before you turn 59 and a half without any 10% penalty. And you don't have to wait 5 years like you do on a Roth IRA. There are advantages. So in my mind, a cash value policy designed properly with, say, an indexing strategy can be a very decent alternative to qualified plans. And especially when there's need for insurance as well to protect the family or the estate.
Now I understand why you have annuities on your list here, the tax deferral. We've talked about this during the week and other shows. But now you're making specific, consider annuities that have LTC linked benefits. Talk a little bit about that.
Yeah, what's interesting is there's not many places where you can get some sort of tax benefit and then have it come out tax-free at the end. An annuity isn't as good from a tax perspective as a life insurance policy because you don't get a deduction, you do get deferral, but then you have to pay taxes, and you may have to pay a 10% penalty. Well, one of the ways you get money out of an annuity is with an LTC-linked benefit. If you accumulate that benefit tax deferred, that's pretty cool. And now when the distribution comes out for long-term care benefits, and if it qualifies, then there is no taxation for the use of that money for the LTC
specific to
long-term care.
reimbursement or indemnification.
Right, and if you think about it, I mean, long-term care policies themselves and medical policies is one of the few places where you get a deduction up front potentially, and when it comes out, it's tax-free. Now, those assets don't have cash values generally like a life policy does, or an annuity. So annuities can be attractive and useful in certain circumstances. They're not as good as life insurance for younger people. I would absolutely use life insurance first.
With an LTC rider on it, maybe?
Well, you can add that in there too. Usually you can get them for free sometimes, or
they're embedded in the contract.
Or they're embedded in the contract, or they're inexpensive riders. So yes, absolutely.
Well, when I think about the Pension Protection Act, this really helped out because we have people that have annuities that say, I don't even know if I'm going to use this. But if we 1035, it's my understanding, non-qualified of course, but you can 1035 over to one of these contracts that have these linked benefits for LTC. And as you said, that'll come out reimbursement or indemnification. This could be a great way. I love this idea. And it was really a good perk in 2006.
It was. And there's a lot of people that have annuities. And if you ask them, are you going to use them? Well, no, I don't intend to use them. I'm going to leave it to the kid. But it just makes me feel good that it's there. Well, here's a situation where you say, well, not only is it good for the kid and make you feel good it's there, but it can actually help you with long-term care in a tax-favored, tax-advantaged way.
Why should I buy capital gain assets such as real estates and stocks for 2014?
Well, if that type of asset is appropriate for your risk tolerances, you get a couple of things. You not only get tax deferral, but you may then, when it comes out, get a favorable tax treatment.
Got to hold it.
Yeah. If you hold, say, a piece of land for 10 years, and it's out on the outskirts of the area you're in, and the area builds out to that, and at some point the raw land goes through the roof, you didn't have any income to pay taxes on, it was pure appreciation. Of course, you're gambling that it will go up. And then when it comes out, assuming the tax law is as it is today, it's more than a year, it comes out of cap gains rates, so you get deferral and capital appreciation and capital gain treatment. So that type of asset can be attractive. And you may have stocks that don't pay dividends, so you don't pay any current earnings. Individual stocks, or maybe an indexed mutual fund where there isn't a whole lot of turnover in the portfolio that creates distributions on a 1099.
Another thing that you put on the list, and we talked about this earlier in the week, is consider a Roth IRA conversion for some of your qualified plans. We have to look at this because maybe if we did something at the beginning of this year, and we kind of feather it through for the next 3 to 5 years, this could be the way to go.
It could be. It's something to take a look at, run the numbers, and determine whether it's appropriate or not.
Those are some of the top 5 things that Ken's looking at so you can begin your 2014 correctly. Well, that's our show for today. Remember, you can read all my online insurance news commentary, advisor blogs, and articles at Producers Web, and my answers to consumer questions on the Insurance Library. And don't forget to view any of our past episodes on our on-demand section located at downtobusiness.ashbrokerage.com. So follow me, Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. For Ken Davis, I'm Steve Savant. Have a good weekend.